Getting prepared for a finance interview can be challenging. This video will provide you with a rundown of the top 20 basic finance interview questions and their answers. This comprehensive guide will help you navigate your way through potential questions you may encounter. It will provide you with the confidence needed to ace your finance interview. 1. What is finance, and why is it important for businesses? Finance refers to the management, creation, and study of money, banking, credit, investments, assets, and liabilities. It involves the understanding of the financial markets and the basic economic frameworks that guide them. It is crucial for businesses for several reasons. Firstly, finance helps businesses make strategic and operational decisions by providing accurate and timely information about the organization's current and future economic condition. Secondly, it helps businesses raise capital, manage risks, allocate resources, and maximize value. Lastly, it facilitates decision-making and planning, enabling businesses to achieve their goals and objectives. 2. Can you explain the difference between accounting and finance? Accounting refers to the systematic and comprehensive recording of financial transactions pertaining to a business. It involves the process of summarizing, analyzing, and reporting these transactions to oversight agencies, regulators, and tax collection entities. The financial statements produced by the accounting process are useful in making decisions about how to allocate resources within a company, government, or individual. On the other hand, finance is a broader concept that describes the management of money and other assets. This field is concerned with the planning, raising, controlling, and administering of funds used in the business. It involves balancing risk and profitability while attempting to achieve an entity's financial goals. It is split into 3 different categories: public finance, corporate finance, and personal finance. In simple terms, accounting is more about accurately keeping track of a company's financial transactions, while finance is more about managing and planning how to best use a company's resources. 3. What are the 3 main financial statements, and what do they represent? Financial statements provide a summary of a company's financial performance and position at a particular point in time. There are 3 primary financial statements. The income statement provides information about a company's revenues and expenses, leading to net income or loss for a specific period. It reflects how well a company generates profit through operations. The balance sheet provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. It shows what a company owns, owes, and the amount invested by shareholders. The cash flow statement shows the inflow and outflow of cash within a company for a specific period. It categorizes cash flow into 3 activities: operating, investing, and financing. These statements are interconnected and help stakeholders understand a company's financial health, profitability, and cash position. They are crucial for making strategic business decisions, assessing performance, and planning for future growth. 4. How do you interpret a balance sheet? A balance sheet is interpreted by understanding its components: assets, liabilities, and equity. Assets are what a company owns, including cash, inventory, property, and other items of value. Equity is the difference between assets and liabilities, representing the ownership interest in the company. When interpreting a balance sheet, you evaluate the liquidity, efficiency, and financial structure of the company. Liquidity refers to the company's ability to meet short-term obligations. This can be assessed by looking at current assets and current liabilities. Efficiency measures how effectively a company uses its assets to generate revenue. This can be evaluated by analyzing turnover ratios. The financial structure shows the proportion of the company's financing from debt and equity. A high level of debt might indicate high risk, while a high level of equity might suggest more financial stability. 5. What is working capital, and why is it important? Working capital refers to the difference between a company's current assets and current liabilities. It's a measure of a company's short-term financial health and operational efficiency. If a company's current assets exceed its current liabilities, it has positive working capital, indicating it can pay off its short-term liabilities. Conversely, if current liabilities exceed current assets, the company has negative working capital, hinting at potential financial trouble. Working capital is important as it helps investors and creditors understand the company's ability to meet its short-term obligations. It also provides insight into the company's operational efficiency. A steady and increasing working capital trend generally indicates good financial health, while a declining trend could signal potential issues. 6. How can a company have a positive net income but still face bankruptcy? This situation may arise due to several reasons. Primarily, a company may be over-leveraged, meaning it has too much debt. Even though it's making a profit, the debt payments may be so high that it cannot meet its obligations. Another reason could be poor cash flow management. Net income is an accounting concept and includes non-cash items like depreciation, while cash flow represents the actual cash coming in and out. If a company is not able overall to convert its profits into cash, for example, if it's not collecting receivables, it could face bankruptcy. Also, having significant future liabilities, like a large lawsuit judgment or extensive pension obligations, can cause bankruptcy. These liabilities can be more than current profits, leading to financial difficulties in the long term. Lastly, a company could face a sudden market change or a loss of a major customer that adversely affects its anticipated profits, pushing it towards bankruptcy. 7. What is a cash flow statement, and why is it crucial? A cash flow statement, often regarded as one of the primary financial statements, provides a comprehensive overview of the cash inflows and outflows from a business during a specific period. This document is crucial as it accurately depicts how a company generates and uses cash, which can be in operating, investing, or financing activities. By scrutinizing the cash flow statement, one can gain an understanding of the liquidity and solvency position of the business. It can also help identify any potential cash flow problems early on and take corrective measures. For investors and creditors, this statement serves as an essential tool for assessing the company's ability to generate cash to meet its obligations and fund its future growth. 8. Can a company have positive cash flows while facing financial problems? Yes, indeed, a company can experience positive cash flows while simultaneously grappling with financial issues. This scenario can occur when a company's operational activities generate significant cash inflows, but its financial or investment activities are draining resources at a higher rate. For instance, if a company is heavily leveraged and its debt payments are substantial, these financial obligations might overshadow the cash generated from operations. In addition, a company might be selling off assets to generate positive cash flow, which is not sustainable in the long run. Similarly, financial problems could stem from poor investment decisions, resulting in substantial losses despite positive operational cash flow. A business may be profitable on paper with positive cash flows, but it could be on the brink of financial crisis if it fails to manage its debts, investments, or other financial obligations effectively. Hence, a thorough analysis of all three key financial statements, income statement, balance sheet, cash flow statement, is necessary for a comprehensive understanding of a company's financial health. 9. What is the difference between profit and cash flow? Profit and cash flow are two distinct financial parameters that inform about a company's financial health. Profit, also known as net income, refers to the surplus left after all expenses and taxes have been deducted from revenue. It is calculated at a specific point in time. On the other hand, cash flow denotes the net amount of cash and cash equivalents moving into and out of a business over a particular period. It provides insight into a company's liquidity and operational efficiency. So, a company might be making a profit, revenue greater than expenses, but still have a negative cash flow due to massive investments or inability to collect payment from customers. Whereas, a company might have a positive cash flow but not making a profit. Hence, profit is more about timing, and cash flow is more about the actual inflow and outflow of cash. 10. Explain the concept of time value of money. The time value of money, TVM, is a fundamental principle in finance that describes the idea that money available today is worth more than the same amount in the future due to its earning potential. This foundational concept in finance acts as the basis for things like interest rates, compound interest, and amortization. The idea is that money can be invested to earn interest or dividends, which is why we prefer to receive money now rather than later. If you are given a choice between receiving a certain amount of money today or the same amount in the future, you would choose to receive the money today because of the potential to grow that sum over time. For example, if you receive $1,000 now and invest it in a savings account that pays an annual interest rate of 5%, after 1 year, you would have $1,050. Therefore, the value of that $1,000 today is actually $1,050 a year from now. This principle is crucial in understanding the true cost and benefits of financial decisions. 11. What is the difference between equity and debt financing? Equity financing involves raising funds by selling companies' shares to investors. When an investor buys a share, they are buying a part of company's ownership. This means they have a claim on company's future profits. However, it also means that they have a say in how the company is run. On the other hand, debt financing involves borrowing money from a lender that must be paid back over a specified period with interest. The lender has no control over how the business is run and their claim is limited to the repayment of the loan. Each type of financing has its pros and cons. With equity financing, you don't have to worry about paying back a loan, which can be a big relief for a struggling startup. However, you are giving up a share of your business. With debt financing, you retain full control of your business, but you also have the burden of repayment. 12. What is a dividend, and how does it affect a company's financial statements? A dividend represents a portion of a company's profits distributed to its shareholders, typically in cash or additional shares. The decision to pay dividends is made by the board of directors and it affects the company's financial statements in several ways. First, the announcement of a dividend creates a liability for the company, which is reflected in the balance sheet. It remains a liability until the dividend is paid. Upon payment, the company's cash balance decreases. Second, dividends are deducted from the company's retained earnings, reducing the equity section on the balance sheet. This reduction can impact the company's equity ratio, a key indicator of financial health. Despite these impacts, dividends can demonstrate financial stability and profitability, attracting potential investors. 13. Explain the concept of risk and return. Risk and return are two key concepts in finance. Risk is the probability that an investment's actual return will be different than expected. This includes the possibility of losing some or all of the original investment. It is usually measured using the historical returns or average returns for a specific investment. On the other hand, return is the gain or loss made on an investment. It is usually stated as a percentage and includes income received on the investment as well as any change in its market price. In simple terms, the risk and return concept states that the potential return rises with an increase in risk. Low levels of risk are associated with low potential returns, while high levels of risk are associated with high potential returns. 14. What is the difference between gross profit and net profit? Gross profit can be defined as the profit a company makes after deducting the costs associated with making and selling its products, or the costs associated with providing its services. Gross profit will appear on a company's income statement and can be calculated by subtracting the cost of goods sold, COGS, from revenue, sales. On the other hand, net profit, also referred to as the bottom line, is a measure of the profitability of a venture after accounting for all costs and taxes. It's the revenue remaining after all expenses and costs have been deducted. The costs deducted to arrive at net profit include the COGS, operating expenses, rent, utilities, salaries, interest on debt, and taxes. In simple terms, gross profit reflects the core business profitability while net profit shows the firm's overall profitability. 15. How do you calculate the break-even point for a business? In simple terms, the break-even point for a business represents the point at which total revenue equals total costs, meaning that the business is not making a profit but is also not incurring any losses. It's crucial to a business as it provides the minimum output level required to avoid losses. To calculate it, you need to know the fixed and variable costs of a business. Fixed costs are costs that do not change with the level of output like rent or salaries. Variable costs, on the other hand, vary directly with the level of output like raw materials. 16. What is financial leverage, and how does it impact a company's performance? Financial leverage refers to the amount of debt a company uses to finance its assets. When a company uses financial leverage, it borrows money instead of using equity to finance its investments, hoping the profits made from the investment will exceed the cost of borrowing. The impact of financial leverage on a company's performance can be positive or negative, depending on the situation. If the company's investments generate a higher return than the cost of debt, the use of financial leverage can increase the company's return on equity and earnings per share, which is beneficial for the shareholders. However, if the return on investments is lower than the cost of debt, financial leverage can lead to significant financial distress for the company, potentially leading to bankruptcy. Therefore, while financial leverage can potentially increase a company's profitability, it also increases the risk. 17. Explain the difference between primary and secondary markets. Primary and secondary markets are both vital parts of the financial system, yet they serve different functions. In a primary market, securities are created and issued for the first time. This is where companies, governments, and other groups raise funds through bond issues and initial public offerings, IPO. Investors buy these securities directly from the issuer. On the other hand, secondary markets provide a platform for the subsequent trading of these securities. Here, investors buy and sell securities among themselves, which the issuer is not involved in. This is where most stock trading happens, on exchanges like the New York Stock Exchange or NASDAQ. The secondary market provides liquidity, making it easier for investors to sell their securities. 18. What is hedging, and why do companies use it? Hedging is a strategy utilized by companies as a preventative measure against potential financial risks. Think of it as an insurance policy. It's a way to protect themselves from price fluctuations in the market that could potentially lead to significant financial losses. The primary purpose of hedging is not to make profits but rather to limit losses. Companies engage in hedging activities to lock in costs or revenues for a specific period, providing certainty and stability in an unpredictable market. This way, they can plan their operations efficiently without worrying about market volatility. For example, an airline company might use hedging to protect itself against potential future increases in fuel costs. By entering into a hedging contract, the company can lock in the current fuel prices for a specific period, thereby reducing the risk of increased operational costs should fuel prices rise in the future. 19. What are derivatives, and how are they used in finance? Derivatives are financial contracts that derive their value from an underlying asset. These assets may include stocks, bonds, commodities, currencies, interest rates, and market indexes. Derivatives can be used for several purposes in finance, such as 1. Risk management. Derivatives enable businesses and investors to protect themselves against changes in market prices. For example, an airline might use fuel futures to lock in a price for jet fuel for future delivery, reducing the risk of price increases. 2. Speculation. Traders and investors can use derivatives to speculate on the future direction of underlying asset prices, hoping to profit from price changes. 3. Arbitrage. This involves taking advantage of a price difference between two or more markets. A trader could buy a derivative in one market and sell it in another where its price is higher. 20. Why is it important for companies to have a budget? A budget serves as a roadmap for businesses, guiding them in their financial decisions. It enables companies to allocate resources efficiently, ensure financial stability, and set performance standards. A well-structured budget can aid in tracking cash flows, identifying trends, and making adjustments as needed. It also provides a framework for measuring performance against set goals, thereby fostering accountability within the organization. By creating a budget, companies can also anticipate potential financial challenges and devise strategies to combat them. In essence, a budget acts as a financial tool that helps companies navigate their path towards achieving their business objectives. We've now walked through the top 20 basic finance interview questions and answers, providing you with valuable knowledge to ace your upcoming interview. Don't forget to like this video if you found it helpful, and subscribe to our channel for more useful content and guides. We wish you the best of luck with your interview.